it is such a bad time to be mining, and yet hash rate's mooning right now. So I have kind of like two I guess theories on that. Either A, the like super cynical take would be like maybe someone's trying to squeeze out the other inefficient guys like Rockefeller style, and maybe they have like a huge capital base, right, and they're able to like temporarily operate like either at break even or like slightly underwater, but at the same time they can squeeze out all the inefficient guys and then buy all the rigs cheap.
What's up, everyone? We got another episode of 0x Research here, a show hosted by analysts for analysts, where we bring on the top research talent, project founders, and thought leaders in the space to ask the hard questions. If you're deeply in the weeds of crypto, then this one's for you. I'm your co-host, Dan Smith.
And I'm your co-host, Sam Martin, and this show is made possible thanks to our incredible sponsors, Chainalysis and Flipside. Today we're joined by 0x Pibbles and Westy from the Blockworks research team. Guys, let's hop right into the hot seat, cool throne. Westy, we can start with you. Who you got for your hot seat?
Yeah, I can start us off here. The hot seat, I got some crypto tech stocks. So I know last week, the week before, we had some pretty bad earnings when it came to tech stocks in general, with Snap being the main culprit. But this past week, we had some pretty bad earnings calls for crypto-related stocks. So the biggest one was Coinbase. Basically, we saw their revenue was definitely not up to par with what we were expecting, although they did have an increase in subscription revenue, which is sort of where they're heading in the future. So there was that caveat, but the main source of their revenue came from interest payments, which was as a result of higher federal funds rate. And so just a sign of the times. And so, yeah, the revenue numbers weren't good, and it hasn't been trading very well since those earnings came out. I think it's down like 10% since. And then we also saw Meta, which I'm going to lump in here because they're investing pretty heavily in the metaverse. But yeah, their earnings are pretty abysmal as well. Advertisers are just not paying as much on the platform. And one of the interesting things is that it looks like they're going to be shelling out $250 billion over the next 10 years into this sort of metaverse platform, which I think investors didn't really like because that's like the biggest investment we've seen in anything since the Apollo moon missions on like an inflation adjusted basis, which is just absolutely wild. I know like I'm a believer in the metaverse as a whole concept, but in Facebook's specific vision, like I don't know if it's going to work out exactly as planned, and I think that's what a lot of people are thinking. But, I mean, that's definitely the hot seat for me. And then cool throne would be Eric Voorhees. For those that didn't see the conversation between him and SBF on Bankless, I highly recommend you check that out. Basically, they had a debate about crypto regulation. Like what does that look like? What should that look like? And Eric Voorhees very eloquently put sort of the ideologue's case for crypto, like why we're here, why we're building, and it was just beautiful to hear. And so like people within crypto definitely loved the message that he was spreading. But at the same time, what was super interesting is that people in DC actually thought SBF won that debate, whereas people in crypto thought it was Eric that won by a landslide. So I thought that conversation was super interesting, and I loved the way Eric Voorhees sort of put like why we're building and why like we shouldn't be accepting bad regulation into the space.
Just to hit on your hot seat there, definitely agree. It's pretty brutal when you see, I think like, Facebook's or Meta's now wiped 7 years worth of gains out. So yeah, we, in the industry, we get a lot of heat for being overly volatile, especially on the downside. And then you look at things like this, it's, like Meta is held by plenty of institutional grade investors that clearly know what they're doing. So it's interesting to see this. And when you put things in perspective of are we exploring which new frontier are we exploring, space or the metaverse? That's actually I hadn't heard that comparison before. That's a wild analogy there. I definitely am like fascinated by the metaverse and think GameFi has a real use case for crypto. But wow, that's kind of astonishing. Do you think this is going to pay off for Meta?
And that is the question. I mean, they pivoted their entire name to Meta. Like this, they're all in. And like, is this going to work out? Like, I think so. Like, I think like in general, they're building towards that future. I think maybe they might be overpaying or overinvesting, but at the same time, I think it's going to work out because of the major technology companies. They're the first ones to really recognize that that's where the future is going. So I think it's going to work out, and maybe Meta stock is a good buy, but in general, like no one really knows at this point. Investors, I mean, according to the market, don't think it's a good idea or don't think it's going to work out. But yeah, I guess we'll see.
I'd take Meta over Snapchat, though. I mean, there's no way in hell I'm buying a Snapchat subscription. Like, absolutely not. So at least Meta's working towards something a little bit bigger is what my take would be there. I've yet to listen to the Bankless debate with Eric and SBF, but that's been on my to listen to list, so I'll be sure to do that this week.
Peoples, you want to rock and roll? What you got for hot seat, cool throne?
Yeah, for hot seat, I have the Art Gobblers mint. It's free to mint. Immediately priced everyone out because that floor instantly went to 10 ETH. The only way to get free mint was to hold hands with someone on Paradigm, for lack of a more obscene phrase. So hand holding with Paradigm. Everyone got priced out immediately. Everyone was super mad. And now you look at the floor and it is down 50% from launch. And you saw the GOO token, which was trading at $3,000 off the bat, is now $30. So definitely hot seat. And then for Cool Throne, I have anyone who was holding art blocks of any type. They got free friendship bracelets last week. There's a 18,000 supply, and each art blocks holder can mint 2 for free. And they're sitting at like a 0.2 floor right now. So that's some nice free money for all the money anyone lost on art blocks.
I know you're an NFT guy. Were you dabbling in some of these friendship bracelets?
I claimed them and sold them too early, and now I'll just watch them.
No.
Yeah, going back to the Gobblers, that was definitely one of the most sought after whitelists in a while. I know, like, I was trying to basically had a draw tool, and they were accepting anyone that drew good art with their tool, and I tried my best. I drew like a panda and a couple other things, and just tried to get you had to get the art Gobbler like critics' attention. It was this like whole complicated thing. I spent way too much time trying to get on this whitelist and didn't get in. Yeah, you definitely had to hold hands with some Paradigm folks to get that. It's pretty brutal.
Yeah, and for the audience, Westy is actually very impressively artistically talented, a bit of a singer and an instrumentalist himself. So you can imagine his images were significantly better than myself and the rest of us out there trying to scribble with a mouse and key.
Yeah, I know mine was a terrible attempt, so I'll move on to my hot seat and cool throne. For the hot seat, I've got Solana again. I think I put them in there last week, but TVL is below 900 million. They're flipped by Arbitrum and Optimism, 2 of the leading ETH L2s. You know, the Mango exploit was bad. There's a lot of drama going on with royalties and NFTs. And that's like a huge aspect of the Solana ecosystem is NFTs. It's kind of like their bread and butter. And then it's also down about 7% as of recording with the SBF CZ drama we've been seeing on Twitter. I guess I will caveat with they had a big Google Cloud partnership, and they also have intent to partner with Instagram as well as Polygon on their NFT sales. So I guess that's kind of how you could rebuttal there, but I still have Solana on my hot seat. I'm not a huge fan. In terms of cool throne, I would have to go with Polygon. They've got partnerships with Meta to enable the NFT minting and trading that I just mentioned on Instagram, although Apple still gets their 30% cut, of course. And then DraftKings runs the 12th largest validator last time I checked on the proof of stake commit chain. Then you got Starbucks and Reddit NFTs. The list really goes on. JP Morgan executed their first DeFi trade on Polygon last week. And Mihalio, I might be botching that pronunciation, but he said on Twitter that a tokenomics revamp is coming pretty soon. So I'm looking out for that. So I guess they're on my cool throne.
Yeah, going back to the Solana stuff, like I definitely get where you're coming from, but I heard like this week because they had their Breakpoint conference that there were a lot of like really cool builders, and that like some people said it was like the most sold out conference that they've seen, like the most crowded, which is pretty surprising given, like you said, that their TVL has dropped off a cliff. And so maybe there's more coming down the pipeline. And I also know there's people raising for building like C-level virtual machine execution environments and rollups on like other base layers. And so, maybe it ends up living on. But yeah, things right now definitely look bleak, but there might be some inklings of a better future. I mean, I definitely hope so.
Yeah, I saw on Saturday the Google Cloud news. They're running a validator, and Solana went like 20% in a few hours while I was away from the desk and eating breakfast. So it was cool. And then also Jump has something. It's called like Fire Dancer, but they're doing something with Solana. I don't know what it is, but they're shoving like tens of millions of transactions through on their own runtime, and it's supposedly pretty good tech.
If you guys had to hold a bag of AVAX or SOL for a year, which one would you choose?
Ooh. I'm going Solana. I think there will be a use case for like high TPS chains. Even if we don't know what that is today, right? Like, I like how they're building out in this like mobile stack. No one else is even like thinking about that direction, let alone building in it. And so yeah, it's like, you always hear the comparisons, like when the internet was built, nobody ever thought you'd be getting in a car driven by a stranger, right? Like Uber. That was just not conceivable at the time. And when we're building this new technology of blockchains, like we definitely don't know the end state of where this is going. I just can't really conceive what this technology is capable of. And there's a pretty good probability that high throughput chains will have a role in the future. So I'm going Sol.
I'm also Team Sol. I mean, Avalanche has Steve Harvey bringing family game night to the blockchain. Solana has the phone. I mean, they did Coachella tickets. So there's.
I know you're playing that Steve Harvey game.
Yeah, it's my favorite game. No, I'm going Sol as well. I mean, these guys already said it. They just have way more going on at the moment. I mean, they just announced what Meta's using them as NFTs, the mobile stack, as they said. It seems like there's a lot of builders, whereas Avalanche, I've heard basically nothing in terms of big integrations, partnerships, and whatnot. And so, yeah, I mean, at this moment, I'm definitely going Sol.
All right, Sam, you know what that means. Forces you into the corner of taking the bull case for AVAX. What you got?
I literally can't do it. I would take Sol, and I just had them on my hot seat, so I'm not taking Harvey.
Fair enough. Well, my hot seat cool throne kind of centered around this weekend's drama. I think I was writing our newsletter today, which, shameless plug. If you're not subscribed to the Blockworks Research newsletter, definitely do so. We'll throw a link in the show notes for sure. But I found this quote, and it was, "You can't underestimate how traumatic divorce is for the children." I think everyone's really losing with this Binance versus FTX battle. These are two massive figureheads in the industry that have the full capability of pushing this space forward. So I'd really love to see them kind of like, maybe not necessarily working together, but not like adversely spending their time attacking each other on Twitter or on chain. Either of those we just don't need. And to kind of put some context around what all happened, I think it was like last week or maybe the week before, there was some reporting that came to light that kind of was highlighting, hey, maybe Alameda's not as solvent as we thought. But Caroline, the CEO of Alameda, quickly tweeted out like a correction. It was like, hey, we have over $10 billion of assets that weren't on this circulating report. Like everything is shored up. We're good to go. Back when the liquidity crunch happened and during the 3AC collapse, all these debt providers were really like crunching it, like with calling back these loans and kind of tightening their books. And Alameda did compliantly with no problems. So. It's hard to believe that FTX or their like sister trading firm would actually be truly insolvent. Just that would be a real shock. Like 3AC was definitely surprising, but I think a lot of that we just got blinded by the bull run more so than anything else, and like thought these guys were geniuses, but they were just levered long everything in a bull market. Whereas FTX is like generating a ton of revenue. They do have some, like they're on the Alameda side, they do have aggressive trading strategies that aren't necessarily the most community friendly, but it's a little more complex in the operation they're running. But it got interesting when CZ of Binance kind of saw this insolvency drama and was like, openly stated he was willing to market dump like $500 million of FTT, which is a highly illiquid token, right? So if you're just going to market dump this, you're gonna be causing serious externalities on market price. And Caroline tweeted back at him pretty quickly. It was like, hey, we'll buy all of this at $22, which was pretty cool to see. She's out here defending the line against a 9-figure dump. So that kind of throws any insolvency risk out the window. This kind of led to SBF and CZ kind of going back and forth on Twitter. But this morning I woke up to a pretty funny tweet that from SBF that said, FTX is fine. Assets are fine. I've gotten in one too many disagreements with my girlfriend to know that when someone tells me I'm fine, they are most certainly not fine. So that was kind of this red flag for me. But again, like I just really don't see a world where FTX is actually insolvent. So, for a winner and loser of this debate, I'm going hot seat SBF. I feel like he's just been in the news for all the wrong reasons these days, and more so the driving factor here is CZ on the cool throne. Because anytime you can flex a 9-figure market dump on somebody, that's just badass. There's no other way around it. Curious if any of you guys have any hot takes about this.
I mean, the assets are fine tweet definitely gives me some like steady lads deploying more capital type vibes. But no, I agree with you that like it doesn't, like I don't think they're even close to insolvency. I think this was just kind of definitely a weekend entertainment as it was. But yeah, I think funds are safe, things are fine. It is interesting what's sort of happening on chain in terms of Alameda dumping a bunch of random altcoins and sending funds back and forth. It does seem like there's some sort of scrambling going on, but specifically what's happening, I don't know. But yeah, overall, I definitely think the insolvency rumors are just way overblown. Everyone loves fear porn in this bear market. So yeah, it is what it is.
Yeah, I'd say the only thing it confirmed for me was I'm willing to pay $8 for Twitter every month. I mean, it's not often you get to watch billionaires just go back and forth in the open on the solvency of their companies. So I'm all for the $8 sub.
Hell yeah.
I'm heavy team CZ just because he's given multiple opportunities to anyone who's paid attention for like the past 3 years to just make like crazy wealth. Like he complies with regulation when it's time to comply with regulation, but until then it's like lawless. So he'll continue to just offer anything he can. Versus Alameda, I mean, if you're trading on FTX, I know people who specifically don't trade on FTX because Alameda will eat your lunch just market making that. Like you will have a better chance winning some trades on Binance.
Yeah, no kidding. Sam, I think you win the best take though. $8 is a drop in the bucket for this kind of drama. But yeah, I think it's a good segue to kind of move into our Flipside Dash review. So Flipside is one of our great sponsors who's so willing to work with us and make this episode possible. And we're going to do a little bit of a Dash review here. So for those of you who are unfamiliar, Flipside is an open source data provider that aggregates blockchain data and makes it available for anyone to query and build dashboards for review. So we're going to take a look at one of these dashboards here. I'll throw this up on the screen. We're going to do a little bit of a deep dive and kind of walk through what the Art Gobblers collection is. And it's got some unique economic incentives here. So Pibbles, can you walk us through kind of what this project's all about and some of the uniqueness to it?
Yeah, so to start, Art Gobblers is Rick and Morty founder Justin Roiland's foray into NFTs. He did this with Paradigm. They've been working on it for a while. They hyped it up a lot. So the biggest thing with Art Gobblers is it was a free mint if you could get on the whitelist by stroking Paradigm's ego. So a lot of people were really displeased, like we talked about earlier, with the mint process and how that was split up. A couple cool things about Art Gobblers is that it's basically like a slow motion Olympus DAO. So you hold these gobblers and they generate goo, which is an ERC20 token. So the more goo you have in your gobbler's tank, the quicker you get goo. And the reason for goo, or the use case for goo, is to mint more art gobblers. So they only minted 2,000 at the start. The max supply is 10,000. And by holding gobblers, you can get a ton of goo, and that's how you'll mint more gobblers. And then there are some legendary gobblers who will start at a Dutch auction of, I think, 69 gobblers to mint a legendary gobbler. So the play here is for people to pool together their assets, get as much goo and gobblers as they can, and then hopefully mint the legendary. Another cool thing is you can use goo to mint pages. And pages are what you can use to, you can commission an artist or you can draw yourself. You can draw different art on these pages that cost goo, and then a gobbler can eat pages. And then once they eat that page, they'll forever have that piece of art in their stomach. So there's a lot of fun mechanisms going on with art gobblers. So good tech, but terrible distribution. So
Okay. Let me try to unpack this for a second. So, Art Gobblers is an NFT collection with these hilarious looking guys. If you can, like here, like I mean, what are we looking at here? I love it. Definitely get the Rick and Morty vibes from these guys without a doubt. And so, I have my Gobbler. He is creating goo, and the more goo that he creates and stores in his tank, then the quicker he produces more goo. So it's sort of like the more the merrier. So I guess the goal here would be to accumulate gobblers and goo, and it's sort of like you can see where the Ponzi's coming in here. Don't want to be the last one holding goo, but you got to time it right because as soon as you start dumping your goo, you're making less goo. Is that kind of how you see this?
Yeah, that's correct. And so, like,
awesome. Well, then I'd love to kind of walk through this dashboard here. I want to give a quick shout out to the author of this dashboard, Farhadi Naveed. Again, using the power of Flipside's on-chain data, he was able to throw this together. But yeah, can you take us through this dashboard? And there's a lot of cool information on here. I'd love to get your take on kind of how you see this playing out.
Yeah, so if you scroll down, there's a chart that shows top collections by volume. And because these were 10 ETH out the gate, you can see right there Art Gobblers volume compared to other collections in October. It just about flipped CryptoPunks, and it was running for all the blue chip collections. So pretty crazy in the middle of a bear market that they could just pump this volume like that. And this is actually a really cool chart put together that visualizes that well.
Yeah, so it looks like we did about $15.5 million of volume in the Art Gobblers, where the CryptoPunks were at 18.96, Bored Apes at 27, more Loot at 61, almost 62 million, and Terraforms at 96. So they kind of ranked here in fifth, and yeah, definitely overthrown or almost overthrowing, or even being in the conversation with like CryptoPunks and Bored Apes is as somebody who is just not an NFT guy, that is still pretty impressive to see the adoption that this is getting.
The real issue with Art Gobblers is that there's like maybe less than 10 wallets. I can't really see that, but there's less than 10 wallets controlling most of the supply of Gobblers. Because if you're trying to get the most goo, or if you want to get a legendary Gobbler, then you kind of have to pool your Gobblers with like a different DAO or a multi-sig or something to stand a fair chance at even trying to win this game. So we have someone who has like 100 Gobblers being the number one wallet. Like, that's pretty insane to coordinate that much with so many moving parts to do the math of like who gets what.
Yeah, so is this just like, groups of like Telegram groups just sending all of their Gobblers to one wallet and just letting these multipliers play off each other and maximize the amount of goo they're extracting?
Yeah. 100%. And then they're trying to mint more Gobblers to hit that legendary Gobbler. But then it's also, there's so much game theory involved with like, when do you empty your goo to start minting Gobblers? Because the price to mint Gobblers goes down if no one mints, but it also goes up if people start minting. So it's just like a huge, like, I don't know, it's a game of hot potato or chicken or something. Like, you just have to see when the buy pressure comes and how you're going to mint the most.
Right, that makes a ton of sense, and I just want to give one more shout out to Flipside here. They have the most comprehensive data for on-chain data in crypto, and it really gives you the best insights you need to work smarter. And you can instantly query all of this data for free, right? So this incredible author built this dashboard without having to pay for any of this data, which is just an incredible. It's kind of the part of the ethos of crypto. It's one of the beautiful things about working in this industry. And so, I just want to say we're going to be doing like a weekly dashboard review where we break down a new dashboard built by a community member. And we're actually doing a $75 bounty in partnership with Flipside. So be sure to check out the link in the show notes. Check out that bounty, and maybe if the winner of that bounty will actually be the dashboard we end up reviewing. So, we're always looking for cool dashboards on hot topics. So feel free to hit us in the DMs on Blockworks Res at Twitter. We're always happy to break down a new dash. And one more thing I want to check out here just before we go is the Goo price chart. So Gobblers launched on October 31st, late in the evening. So on November 1st and bleeding into November 2nd, Goo started trading. And we see that it opened up around, floating in that $1,000 to $3,000 range, and is subsequently down 99%, 98.7% to $27. That is just a wild collapse of asset price. But I bet you that one wallet with 79 Gobblers stashed away is still collecting all this goo, and is probably half the reason why we see this price chart looking the way it looks.
Yeah, I feel bad for anyone who tried to chase the goo chart. That's just down horrendous. Poor guys. But anyways, before we head over to our interview with Will Clemente, I want to take a second to thank our other wonderful sponsor, Chainalysis. They're one of the leading crypto analytics providers that are helping legitimize our industry. They enable investors to track on-chain wallet movements with relative ease. They also offer some great research in the space, which is available for free on their website, and we can link to that in the show notes. They also offer extremely in-depth courses on all things crypto, and they're very much worth checking out. Chainalysis is building the tools our industry needs to bring in the institutional capital, so be sure to check them out in the show notes. All right, we got Will Clemente here. Thanks for joining us on the second episode of 0x Research. Will just launched a research firm called Reflexivity Research. It's an institutional grade research firm that focuses on helping TradFi invest their trillions of dollars into Bitcoin and digital assets. So thanks for coming on, Will.
Hey, thanks a lot for having me on, guys. It was nice meeting you, Sam, in New York, and I know back then we're like, hey, we'll have to do something together, so it's nice to finally hop on a pod and jam.
Yeah, absolutely. I was stoked when I ran into you because I've been following you on Twitter for a while, so it's nice to finally get to talk with you face to face. But before we dive into the report that you wrote, that's really solid on the state of Bitcoin mining, I kind of wanted to get your take on the SBF CZ drama that we're seeing all over crypto Twitter.
Yeah, man. I mean, look, I'm just here with the popcorn. I think it's like super entertaining. I've just been following along. Don't really have a crazy amount of insight. I did see earlier today, though, it seems like potentially there was like an OTC settlement of the FTT that Binance wanted to offload. I saw some like posts about some like on-chain transactions from Larry over at The Block, and Hisaka posted it as well. So it seems like potentially that's been settled, which I think would be bullish for FTT short term and Solana, because there's been like a boatload of shorts that have piled in on both of those. So paying attention to that potentially from like a trading perspective might pump some of those things if I can confirm that. And then I guess the other piece would be on chain. It seems like there's been a bunch of stablecoin outflows from FTX. So there's definitely some people that have been kind of nervous about the whole thing. I think rightfully so after everything earlier this year with 3AC blowing up, all these centralized lending entities that either blew up or took a massive hit. So I mean, look, I think it's just bear market things, right? Everyone's like super on edge with all the people blowing up left and right, and all this counterparty risk that we saw exposed earlier this year. So like I said, I'm just kind of observing for now.
Yeah, I'm with you on that, Will. It's been interesting and agreed. Like the Sunday night drama, who needs reality TV when you got things like this? I'm a House of Dragons fan, so it was nice to have my first season, or my first Sunday without House of Dragons get replaced by some good drama.
At least we've been trading in a 2% trading range, right? So at least we got some form of entertainment, I guess. It's kind of the silver lining.
Exactly. Yeah, it's tough to imagine, FTX to actually be in, true financial trouble here. But yeah, it'd be interesting to watch this play out. And I just am blown away, like CZ being able to like make a flex on Twitter with a nine figure threat. Like that just never gets old to me. It's just such a crazy industry we work in, but it's kind of how the system goes. So yeah, I'd love to dive deeper into that report and kind of get your take on kind of what the public Bitcoin mining landscape looks like. You wrote a great overview that kind of highlighted 4 core questions around this industry and kind of like, what do the current market conditions look like, and why has that been such a difficult environment for these miners to succeed in, as well as who these public miners are, and which ones are best positioned to survive this bear market, and then kind of like what you expect to see the space moving, the direction that we're moving in going forward. So kind of like take those one at a time and start with, really just what the current state of the market is and kind of how this perfect storm of spot price, hash rate, and energy cost is kind of really working against these miners.
Yeah, sure. No, I appreciate the segue there. Yeah, I think, look, this is something that has taken place during every single, Bitcoin cycle and, quote unquote, Bitcoin bear market. So in terms of like the kind of dynamics that are going on, it's not anything entirely new. But I think what's different this time is, you have people that took out these massive loans to purchase rigs and BTC in the bull market. And on top of that, just generally, like, we have these massive publicly traded companies now that they have to post their financials, right? So where historically you kind of knew from a first principle standpoint, the kind of underlying, dynamics that were making the conditions like unfavorable for miners. Now you can actually see, on their balance sheets, what's actually being, taking place. So I think that's really interesting to like actually see it unfold. I guess just to like preface before getting into like the actual like public landscape itself, like just highlighting from like first principles standpoint, like what's going on that's making the conditions so bad for miners. So if you could think about miners' positioning and like how they approach the market, essentially the way you could think of it is they're long Bitcoin spot price and they're short hash rate and also short energy. So obviously as Bitcoin's hash rate increases, there's more competition to mine Bitcoin. And it makes it more difficult for a miner that hasn't increased their mining capacity to get the same block reward that they were getting before. And so what happens traditionally in these kind of Bitcoin cycles is miners serve as like a very pro-cyclical force. So in the bull market, they tend to hold their BTC, and then in the bear market, they become forced sellers. And the reasoning behind that is because as Bitcoin's price is kind of ratcheting up, going 5-10x in the bull run, you have all these people not only that are looking to buy BTC itself, but that are also looking at the returns on mining BTC over the prior year or two, and say, oh wow, look, if this price trend continues, this Bitcoin thing, it might be a great time to start mining. It's like printing free money, right? And so all these people decide to get involved in Bitcoin mining. And you have this massive increase of new machines that are ordered. Now, the thing is, there's kind of a lag between when people order those machines and when they actually get plugged in. And the reasoning behind that is, first of all, they have to get manufactured. And historically, there's been a very small number of people that have been able to manufacture these machines because it's such a specialized thing. These machines are designed specifically to hash SHA-256. And so there's a lag between when they're manufactured, when they're delivered, and then also there has to be shelf space that's built out to house the miners and infrastructure to house the miners. So all of these things take several months to get from the point of saying, hey, look, I want to get involved in mining, to actually being up and running. And so historically, the kind of peak in hash rate has lagged that of the peak of the Bitcoin market price. So I think the clearest example is we look at 2017. Bitcoin obviously peaked at 20,000. Hash rate peaked out, I think it was 2 months after, something around that. And that's because of that kind of lag of when the machines are able to actually get up and running. Now what happens for the miners on the network is it compresses their margins. So as we mentioned, the more people that are mining, the more competition there is. At the same time, the Bitcoin price is declining. So you can look at something called hash price, which takes price divided by hash rate. So essentially, the price per hash. This is like a good gauge for looking at essentially like miner margins, and so you saw that compressed heavily in the 2018 bear market as hash continued to ratchet up, but Bitcoin's price continued to push down. And so when you got to the back half of 2018, and you got it on the screen there, you could see that hash price in the end of 2018 just absolutely nuking. What happened at the end of 2018 was it kind of got to a peak of a lot of these miners just no longer could operate. Right at the beginning, they sell their Bitcoin reserves, they start to unplug machines, and then at the end they have to just either fully pause their operations because they're not profitable at all, or liquidate the entire operations depending on like their financial situation. And so at the end of 2018, what happened was you had a bunch of selling pressure from miners. You could see that in the on-chain data, looking at essentially like wallets that have BTC from Coinbase transactions. Those are labeled as miners. You could see that a lot of sell pressure was coming from those on-chain wallets. So based on on-chain data, it was pretty apparent that that major leg down from 6 to 3K at the end of 2018 was basically primarily like forced miner selling to cover operational costs. And so similar to that dynamic, we have the same thing going on right now. So we have hash rate again that's been ripping up, and over the last month or so, hash rate's been absolutely like mooning. And not to kind of derail the conversation from discussing the market dynamics on like why this is unfavorable for miners, but I do wonder who exactly this entity or group of entities are that's plugging in rigs right now, because it is such a bad time to be mining, and yet hash rate's mooning right now. So I have kind of like two I guess theories on that. Either A, the like super cynical take would be like maybe someone's trying to squeeze out the other inefficient guys, like Rockefeller style, and maybe they have like a huge capital base, right, and they're able to like temporarily operate like either at break even or like slightly underwater, but at the same time they can squeeze out all the inefficient guys and then buy all the rigs cheap. So that's one theory. Not really any evidence backing that, just kind of like trying to conceptualize what maybe is going on. And the other thing
I
would
like
be,
that theory though. I like that theory.
it's fun, right? It's a fun theory.
Yeah, it's a fun
and
one.
then the other one would be just maybe some very large energy producer that hasn't got involved in Bitcoin mining decided maybe they were going to do so over the last 2 years, and they're finally getting up and running, and they have like super cheap energy, like maybe someone who would like otherwise be like flaring off excess gas that that they have to flare off anyway. And so like someone like that maybe makes sense. But yeah, I mean, just from like someone to decide that, hey, look, I'm going to go ahead and just go start mining, like someone like you or me to just go prop up an operation in their backyard, it's such a bad time to do so. So it would, in my opinion, have to fall under like one of those two theories to explain what that increase in hash rate is. But nonetheless, it's taking place. And so as you can see, hash price just hit a new all-time low, which means that it's you could think of hash price as essentially like the difficulty, not to be confused with the actual difficulty of the network, but the difficulty to be a profitable miner, right? And so that in other words is like at an all-time high as hash price hits an all-time low. And then you throw on top of this, not only are these like natural dynamics that have, as we just described, have historically taken place, you have high energy costs, right? And because of all the inflation that's taken place, supply chain issues, the geopolitical situation, war in Ukraine. So all these things have also pushed up energy prices. So you really have like the perfect storm for kind of this minor capitulation period. And so to kind of segue that into, I guess, the public landscape now, we finally started to see that translate into some like public financial disclosures of these miners being under immense stress. Sorry. If we go back to June, we entered kind of like an initial like mini capitulatory period, and what I'm using to define that is something called hash ribbons. So this was created by a guy named Charles Edwards at Capriol Investments, which is like a Bitcoin prop fund in Australia. What he did is he took two different moving averages of hash rate. So he took the 30-day and 60-day moving average. And what he found is that whenever the 30-day moving average of hash rate crosses below the 60-day moving average, that signaled within a week time span an imminent minor capitulatory period. And so that flashed back in June. And so we were in that kind of capitulatory period, meaning the 30-day was below the 60-day for about a month or so. And during that, we saw miners, kind of surface some issues, including Core Scientific selling, I think it was 7,200 BTC for roughly $170 million, basically to shore up cash to cover their debt financing costs. And so, that was kind of the, I would say, initial capitulatory period that we went through back in June. But now it seems like we're kind of slowly entering back into another one, unless you see a material move up in Bitcoin's price, which would, ease off some of the pressure on these guys' margins. But, as we continue to, hang out down here in, the doldrums at 1920K, and have been trading in, a 0.0005% trading range for the last 2 to 3 months, we obviously haven't seen that material move up in price, so their margins, maintain super compressed. And so with that, someone like a Core who sold off a lot of their BTC back in June to kind of temporarily, keep themselves afloat, now they've run out of that capital and they no longer have anything else to liquidate to cover their financing costs. So, last week we put out a report and basically said, hey, look, miners are, in really bad shape here. They, because of all the reasons we just described, we're probably going to see some material issues, in terms of like public disclosure soon. And I had no idea, but 2 days later, Core announced that, basically they're not going to be able to cover their debt financing costs anymore. And likely they're going to be filing for bankruptcy in the next month or so. Here you just pulled up on the screen the Bitcoin miner total debt divided by assets. You can also look at debt to equity ratio as well. But as you can see, Core by far has the highest debt to asset, debt to equity ratios. So that just illustrates, they really prioritized growth, but that's come to backfire on them in the bear market. Look, I mean, I never went through like 10Ks and 10Qs, but from my understanding, like the debt to equity and debt to asset ratios that Core has aren't like insane. But the thing is just the Bitcoin market in general is just so volatile and so cyclical that on one hand, obviously, like having some debt on the balance sheet is good because you're able to grow your business. And so like in mining, you want to have some degree of debt because you have to compete with the other miners, right, to stay at the same level of profitability and to continue to scale up your operations as hash rate continues to perpetually trend up and to the right over multi-year time frame. But at the same time, when we get into situations like this, someone who's been like more conservative, for example, like a Riot blockchain, like on the chart you just had up, you'll see on both the debt to asset and debt to equity ratios, Riot by far has the lowest debt ratios. So on a relative basis, they have the lowest amount of debt. Much lower than even the closest two, which are CleanSpark and Bit Digital. So someone like a Riot is chilling right now, right? Because they have very low debt. Riot also has fixed energy contracts. I think they have a 10-year contract for fixed energy. So they're not stressing also about the higher energy costs. But someone like a Core who kind of prioritized growth in the bull market is now seeing that backfire as we continue to be in this back half of the bear market.
And that's something I want to dive a little deeper on, right? So if we go back to like what you laid out as the perfect storm, right? So a decreasing spot price of BTC, an increasing hash rate, and increasing energy costs. The first two of those, obviously the Bitcoin price and hash rate, those are like these natural free market values that we see. A lot of factors play into like how these go or how these values move, and there's a lot of market dynamics playing out. With the latter, energy costs, of course, that's a free market as well. But you have the ability to hedge off energy prices, and just as you mentioned, Riot has done so. So is this like a very popular tactic amongst these public miners, or are more like I'm just really curious if there's like this element of greed. We see like like the whole industry, right? Like we love to degen long, we love leverage. Like is that something we're seeing with these miners as well? They kind of like trying to roll the dice and avoid any hedging costs on energy, or are they kind of being proactive and taking some risk management strategies here?
No, that's a great question. I haven't looked into like the individual energy contracts that each miner has. I tried to look into that, but I didn't see anything aside from Riot, who that's the only one I know for a fact has fixed energy prices. So yeah, I don't have a great answer on that. But I will say, like in terms of like the greed aspect, several of these miners took out loans to purchase both rigs and BTC, including Core and Marathon. Marathon's like the state of like their financing is a bit better than Core's in terms of like the interest rate on it is lower, so like they're good now in terms of like they can service it, but Core obviously has not been able to.
Yeah, I was surprised too that you didn't see any like Bitcoin miners hedging their Bitcoin spot exposure. Like, because that's what you see in agricultural commodities, right? Like, you sell your futures contract before you even have your commodities in the ground to grow them. Like, I'm surprised Bitcoin miners weren't doing the same thing and, maybe going short Bitcoin in order to hedge their future production. Like, is that something you expect to see a little bit more of in the future, maybe?
Yeah, I think so. I think the thing is, too, a lot of these guys are just also, like, super long-term bullish BTC, and they see this as just a way to accumulate, like, a massive Bitcoin treasury. But I do think, like, moving forward, especially after, like, all this is unfolded publicly, when we get to the back half of this, and, I'm assuming there'll likely be some, like, M&A and financial restructuring for a lot of these guys. I think you'll see more of that kind of sophisticated. Obviously, like, you're capping your upside a bit by hedging that out, but, yeah, I think you'll see more of that moving forward.
Yeah, absolutely. I agree with you. And I think it's important. I liked this chart that you included in the report, but to like kind of put into perspective how decentralized Bitcoin actually is. Like, yes, Core Scientific is a big player with 5% of the global hash rate, but at the end of the day, like it's only 5%, right? Like, what would you say about the decentralization of Bitcoin?
Yeah, totally. Like all of these guys combined have, I think it's roughly 17% of the global hash rate. These are like massive. At the peak of the bull run, we had several $billion public mining companies, and they still total less than 20% of the total hash rate. So yeah, exactly what you just said. I think to some degree this just really illustrates the decentralization of the network. The other thing to kind of note on this chart is like if those rigs get unplugged, and again, I'm not like a distressed debt expert or anything of the sort, but like assuming Core is probably going to announce they're filing for bankruptcy within the next few weeks. Exact restructuring, I don't know how it'll take place. I'm assuming though that the rigs probably won't come offline, but if they did, it's actually like a net good thing for the other miners because you're taking off some of the competition that's on the network. Therefore, like on the margin, easing off some of the pressure on their margins. But yeah, I mean, I would assume, again, like I'm not a distressed debt expert, but I would assume that like the rigs will probably stay online and someone else would just take over their operations. I guess one other thing to hit on that's interesting and kind of like curtailing off that point, when we look at the amount of BTC that these guys hold, it's really not that significant. Like again, like Core sold off, it was roughly 170 mil of BTC back in June. They now only have 24 BTC. So like if Core goes under, like yeah, it's like you don't want to see any individual actor fail in the space. But in terms of like the impact on the Bitcoin spot market itself, it's not that major. And like when you add up all of the top 10 largest miners, they have about 675 mil of BTC at a $20,000 price. So obviously that's not we're not talking like chump change here, but like that's not going to materially move the market because that's also assuming you're getting every single public miner selling their entire treasury at the same time. Even if that was the case, it would be done OTC, and that could be done over like a multi-day period and have very minimal impact on the market. So, from the public's mining standpoint, I don't think the amount of BTC that they have is material enough to gap BTC down another leg to like 14K. Now, what the question that's kind of like up in the air, I think there's I guess two questions that are up in the air. First of all, like how much BTC do private miners have? And like you can look at on-chain data to look at say like wallets that have like received Coinbase transactions, and then say okay, like that's a miner, and then total up the amount of sum that those wallets have. But you also don't know like how much of that is people who just have were mining BTC back in the day and then just like lost their keys, or whatever. So like it's hard to estimate like how much of that is potential sell pressure, but I assume it's larger than the amount that the public miners have. So that's the kind of biggest unknown. At least with these public guys, we can see kind of generally like, okay, how much supply would overhang on the market. What's the exact kind of stance of all these guys, but like in the private market we don't have any of that. So I would say that's one of the biggest questions in terms of like how this will resolve. The other thing is, what's the effect on all of the lenders that lent these guys money, right? So a lot of these loans are collateralized with ASICs, and so you've had several miners that have actually had to deliver because they haven't been able to service their debt, so they've had to actually deliver the rigs. Let me see. I think it was Stronghold recently closed a debt restructuring deal with NYDIG. So they delivered 26,200 rigs in exchange for 67 mil. And then you also had Iris, who stated that they're not able to service their interest payments as well. They're generating about 2 million from mining. Their debt obligations are about 7 mil. So they're going to be selling or giving their rigs back to NYDIG to close out that debt deal as well. So the question I kind of have is, what's the effect on like the ASIC prices if all these guys are liquidating, if all these lending firms are all liquidating the miners at one time. These mining rigs, the prices of them are already down 80%. And then you add on top of that the fact that the market's pretty illiquid right now. If all these guys are all dumping rigs at once, if I'm a buyer, I'm going to say, all right, I'm going to wait for these guys to dump all that inventory, and then I'll kind of scoop it up on the cheap. So that's one other thing I would say I'm watching out for. And like let's say some of these lenders aren't able to get the full dollar amount that they would look to want to get out of these ASICs. What does that put a hole in their balance sheet? And when you're talking about, for example, Core Scientific borrowed from both BlockFi and Genesis, who already took a massive hit from Three Arrows Capital and the fallout of that. So like does that cause some material issues for those guys? I don't know, but that's one other thing I would say to watch out for.
If you can't tell, we love data here at Blockworks Research, and Chainalysis, the leading blockchain analytics company, shares this passion with us. We use data to extract alpha and find the next thing coming in DeFi, but Chainalysis is doing the gritty work and building trust in blockchains. To onboard the next $1 trillion of capital into the industry, we need to grow safe consumer access to cryptocurrency and promote more financial freedom with less risk.
Chainalysis has some of the most comprehensive and reliable data in the space, and they use this data to power a full suite of their solutions that can be utilized by industry professionals. Best-in-class training and certifications are also led by Chainalysis and some of the brightest minds in the space. If you haven't heard of Chainalysis, you got to check them out, and we'll link to them in the show notes.
Yeah, so we think about kind of like where this space is moving going forward. I think it's a huge factor that you pointed out. Even if public miners were to just flood the market with all the spot BTC they held, they really wouldn't move the market in a massive way, because we hear miner capitulation really touted as this huge market risk. So yeah, really appreciative of the insight you can shed on that. And around the private point, it is kind of interesting that we have these multi-billion-dollar corporations that are mining all this Bitcoin, and yet private miners are still even larger than some of these public miners. And so I kind of pose this question to you. Like, what's the landscape of how things are today? And like, so let's say you just stumbled upon a $300 million in a cold wallet that you had from back in 2013 era. How would you kind of think about allocating this capital out? Would you be interested in buying some of these distressed miners, or do you think the better play is just to kind of buy spot Bitcoin?
It's a great question. I think when you think about like when you want to be buying something, it's typically like when there's forced sellers. In the same way that like when do you want to sell something? It's typically like to forced buyers, aka like shorts that are covering, or like people that are short on the sideline and therefore like finally capitulating because price keeps ripping in their face. So they're like technically forced buyers. That's when you usually want to sell things. And so like where we are now, I would say in terms of like Bitcoin itself, a lot of the forced selling outside of potentially the private miners, depending on how much BTC they have, has been done over the last few months. From a lot of just in the crypto market broadly, like with the fallout of everything that took place back in June. But obviously there's like an overhang of that on the actual ASIC market. And so, I would say, if you do get that like final capitulatory like leg down in ASIC prices, that could actually, potentially be a really interesting, time to go ahead and, purchase those rigs and start mining. And you are seeing several funds that are being raised to do exactly this. So, for example, DCG just announced a fund. I think it's like a collaboration between, structured as like a collaboration between Grayscale and Foundry. Bitmain also launched a fund, and then and Binance also launched a $500 million fund. So, and the Bitmain one I think was 250 mil, and I'm assuming Grayscale probably isn't that small either. So, I mean, you're looking at somewhere around like $1 billion of capital, and then, not to mention potentially like, these other like alternative, distressed asset investing funds that are probably looking at these dynamics as well. So, I mean, you're looking at like, somewhere around $1 billion of capital, at least that's like publicly been announced that I found, that's looking to purchase these assets on the cheap. So, like, I do think there is a buyer. It's just a question of like, okay, like, if these lenders are going to have to all sell these rigs at once, is that going to, potentially cause some like final leg down in ASIC prices that, these guys are, kind of salivating over and like sharks swimming in the water waiting for. But in terms of like, like the long-term viability of the space, I've started to see the, Bitcoin miner death spiral FUD that, has taken place several times before in Bitcoin's existence. I don't buy into any of that.
Also, like the Bitcoin price trades in tandem, like with the value of ASICs, so like if you're able to scoop up a bunch of these, it's a productive asset. And then as soon as, you can try and turn them and flip them kind of near the top of their value. So I know I'd be buying some of them if I had $300 million.
Yeah, exactly. And I would say like the way to frame ASICs is like it's an asset that trades at higher beta to BTC and also gives you a dividend through like the rewards that you're getting from mining. So, if you can time the purchase of the ASICs right, like absolutely, I think, it would be very advantageous. Like if you could, purchase on the back half of some, potential for selling.
Yeah, absolutely.
Very
So I've long been like a Bitcoin bull, but the one thing that I'm personally skeptical about is transitioning to a fee-based model as the blog subsidy, keeps declining in half every 4 years. How do you feel about that? Do you think that it's possible to make this transition in the state that Bitcoin's at today? And if so, like how?
No, it's a great question, right? It's something like people have talked about for a long time. I don't really think I have like any super interesting take on this. I'm with you. I think it's something that needs to be solved, but like I'm an optimist in the sense of like I think people will figure it out because they'll have to figure it out. So I mean, look, I don't have a specific solution that like I've come up with that no one else has thought of, but I do remain on like the optimistic side that people will figure it out as we get towards them. But and then like by then I'll be dead anyway, so it doesn't really affect me. I feel like.
Yeah, absolutely. Yeah, no, it's just like kind of interesting to see like the Cosmos Hub. They're moving away from exponential inflation, kind of like replacing the security subsidy with revenues from their interchain security model. We've seen ETH be deflationary, even even despite the bear market demand for block space. So yeah, it's definitely interesting to kind of think about how this was going to affect Bitcoin, and it tends to be a little bit slower in development than some of these other chains. So yeah, I'm with you. Like it's definitely something we need to work on solving.
What about the Lightning Network, Will? Are you
Yeah.
bullish on Lightning Network adoption, or do you view that as kind of a nothing burger?
I mean, I think it has the potential to be something really important. Like it's obviously very small now. I think it's like right around 100 mil in terms of like public Lightning Network capacity. But I think people like Jack Mallers, who recently raised like 75 mil to build out his company Strike, which in the bear market is like not a small sum. There's definitely a lot of people that are working on turning Bitcoin kind of into that medium of exchange. I do just think you kind of get into this like I guess paradox of like on one hand you've got people holding BTC right as like kind of this like long-term store of value, but then at the same time incentivizing people to spend it I think is difficult, at least in this stage of where Bitcoin is, and potentially that's capping off some of the Lightning Network growth that you would see from like Bitcoin native users. Now on the other hand, I do think you have the argument, and I think you could make this for ETH as well, that you've got this like kind of bedrock foundation of Bitcoin security, which I would say is like the most secure of all of crypto. You've got this like bedrock foundation of security for payments to be made on top of. So like very similar to like the use case for stable coins, where people are not only do you have like people using stable coins in market making and just like capital efficiency reasons, but like also people overseas who don't have any access to dollars and are utilizing stablecoins just to be able to they could just open up a digital wallet and instantly get access to dollars. I think similarly you have some like potential use case for Lightning in that sense of permissionless transactions for people that otherwise maybe aren't able to do so. So I think like it's just a question of like, will that use case continue to grow? Because like personally, I'm not spending my Bitcoin, right? Because I view it as a store of value, and hedge against global like monetary debasement, right? So I'm not personally going to be spending it. I'll just spend my fiat, So therefore, like I've never used Lightning in terms of actually using it for transaction. I mean, I've played around with it, right, to just like see how it works. But I'm not gonna go to the store and open up a Lightning channel and try to transact my BTC, because I think the opportunity cost of not holding it is much greater. So I do think that's kind of like a dilemma of like what is BTC? Very similar to kind of like the ETH dilemma, I would say, between ETH being like this ultrasound money, and then also being gas that you have some like money velocity aspect to it of giving ETH value. So yeah, I mean, like I think it's just kind of a question of like what do people view the use case of BTC as. But I do think like over the long term, like as BTC matures, right, like as we're on like this quote unquote like S curve of adoption, like as we kind of get to the plateaued back half of that, then I think absolutely like people will spend their BTC, because you won't have some like rapid monetary appreciation.
Yeah, I think that's a good take. I pretty much agree with everything you said. In terms of back to kind of like steering back to the report where you were talking about Bitcoin mining, like we saw, the exodus from China and the hash rate decline by 30% back, maybe a year ago. I can't remember when it was. So do you think like hash rate, because of how secure the Bitcoin network is kind of just more noise? Or do you view like actual trading signals and on-chain like metrics as it relates to hash rate? Like you mentioned the hash ribbons.
Yeah, sure. So do you wanna talk about on-chain analytics, because that's like a whole nother discussion?
I guess specifically on hash rate, and then if you do want to
rate.
touch on analytics, you can.
Okay. Yeah, we could get into that I guess after too. Sure. Yeah, I don't really think it's necessarily like a trading signal. I'm kind of the belief that hash follows price. Obviously, it's like kind of been like a chicken or egg question, but like I think when we think of back the framework we talked about earlier, right? Like the lag in terms of like the peak of hash rate is after price. That's because people are plugging in rigs because price is going up, right? Price isn't going up because people are plugging in rigs. So I'm kind of in the camp of hash tends to follow price. But in terms of like actual material trading signals, I haven't found much value out of it except for looking at the hash ribbons, which you kind of touched on, which is that the 30 and 60-day moving average. Because whenever you get that kind of bearish cross, what that fundamentally indicates is not that like hash rate itself going down, all of a sudden people think the network is worth less, but the fact that you likely have some type of like forced selling from miners in that case, because machines are obviously being unplugged because hash rates decline.
That makes a lot of sense. Now, we've seen a couple attempts at making Bitcoin kind of like an on-chain reserve asset. Like we saw it with LFG, with Terra and Luna. We hear the Cosmos folks talking about doing that with, I think it's called Babylon. Dan, you can correct me if I'm wrong. But do you see that being a narrative going forward?
I don't know, man. I just think Bitcoin and the USD exchange rate is just way too volatile to have BTC as like a reserve asset at this point, unless you're in a situation like someone like a Sailor, right, where like the debt that he took out to buy BTC is at a very low interest rate, and he doesn't have to pay that back I think until 2025, like late 2025. So like in terms of using it as a reserve asset, I think it also comes down to that, in addition to like what's the size of like the allocation that you're giving to BTC? Obviously, like if it's like 1 or 3 or 5% of your overall balance sheet, like it's not a big deal if it declines 50% or something like that. But like should we be using it as like a short-term reserve asset in the way that like LFG did?
Yeah, I'm with you on that. And kind of winding down now. I know we're kind of running close on time, so I just want to get some insights, kind of from the boots on the ground trader, right? I know you've been tweeting a little bit about how you've been trading, dabbling more in trading some of these altcoins. See your takes on Sushi, and kind of love the insights you've provided. So, kind of want to get your take on what you think will be kind of catalyzing some of these token runs in the next bull run. We see this narrative around real yield. It's becoming super popular over the last couple of months. Is protocol revenue a meme? Will fundamentals actually matter in the next bull run, or will it just continually be about who has the best narrative on a given day and who can get the most eyeballs?
Yeah, it's a good question. I guess we could start with like, what I find useful trading is like, first of all, price action, looking at the derivatives, and then also narratives. And then like with the confluence of those, like if the narrative that's developing is reflected in price action, then that's confirming the thesis you have about the narrative. And then also like watching derivatives to like catch people off sides. Like Sushi, for example, as you said, I've been tweeting about a bit. That's been trading super clean in the sense of like, you can see a bunch of open interest piling in. You look at things like liquidity heat maps to see that like a bunch of longs are piling in, and then once price goes below where all those longs piled in, okay, obviously those guys are off sides, and you've seen Sushi basically like flush people out on both sides like 4 or 5 times now, and that's been trading. I think partially because it's such a PvP market, it's been trading very clean on things like these liquidity heat maps. But like I guess longer term like thematic type of like what you're asking. Yeah, I mean, look, I think the way you got to kind of think about it is like, who are the market participants, right? So like in 2020, 2021, who were the market participants? They were all retail people with like stimulus checks, right? And so like, I think this is why like a lot of the people that expected DeFi to outperform, and like I did as well heading into 2021, were wrong, compared to things like Dogecoin or Cumrocket. They were wrong because like, the amount of capital that was coming into the market in the outsized way was from retail, who again like had stimulus checks and excess capital to kind of gamble on. Heading into the next bull run, who's likely to have who's likely to be the primary like where inflows are coming from? It's probably going to be more of these like traditional funds, I would say, like especially in these market conditions, like. You're not getting a lot of retail inflows. Like retail is like struggling to even pay for food that's like rapidly and increasing relative to their income. So they're not gambling on our shitcoins. But heading into the next bull run, I think who are the basket of market participants that are most likely to be like the outsized capital inflows? It's probably like some of these traditional funds that like checked out crypto over the last few years and like been building out infrastructure. I mean, look, we've seen like crazy announcements this year that like no one's talked about. Things from like Google announcing like a node service, BlackRock offering, crypto to their clients, Citadel building out a crypto exchange. We had JP Morgan using a DeFi protocol last week. We had Arweave collaborating with Meta. Like all these guys are like coming in and building out infrastructure. So I would say those are the most likely basket of market participants to be around. And so to your point, I think like things like real world assets make sense because they're likely to make sense to a lot of the those type of market participants that are going to be driving the outsized inflows. And I just think in general like these financial infrastructure type of products, I think we'll see a lot more of the capital inflows on a relative basis to something like a Dogecoin or a Cumrocket or these other like completely speculative vehicles.
Cumrocket, the reserve asset of the entire world, of course. That makes a ton of sense, and I think it kind of sounds like, in this upcoming bull run, there's always the debate between, will the base layer accrue value or the apps built on top accrue the value, right? So the original thesis was like the fat protocol thesis, where these base layers would accrue a ton of value. But then we saw a lot of these all L1s come out and really just not gain a huge traction, or really never kind of failed to find product market fit. Like these high throughput, high TPS chains like Solana and Aptos have really, they seem, to me it seems like there will be an application for that. I just don't know if we've come across it yet. And so, like, there's always the promise of order books coming on chain, and we've really failed to see that come to life. There's still new attempts at doing this, like say in the Cosmos ecosystem, and they're using their Nitro technology, kind of bringing this SVM from Solana over into the Cosmos ecosystem. But yeah, like, do you have any opinions on whether it'll be the apps themselves or the base layers that accrue this?
I personally don't have any strong opinions on it, but I would love to have our DeFi analyst Knower. People might know him from Twitter. He's got a fairly large account. It's called Knower of Markets. He's brilliant, man. He tends to kind of stand in the camp of like ETH is going to be the winner takes all of the entire space. But to answer your question, like, I just don't want to give you like a half-ass answer if I don't have a good one. So I would say like maybe we'll get him on in a few weeks and he can go into the weeds with you about that.
For sure. I guess we can close it out here with one last question. Do you buy into the flipping narrative between ETH and Bitcoin, or do you think Bitcoin remains king for the very long future ahead?
Yeah, sure. I think you could see ETH like temporarily flip BTC, but like in terms of like, do I think ETH's market cap will be larger than Bitcoin's in like 20 years? I would say no. And the reason is because like I view BTC as like the underlying monetary premium of the world. And I do think like there's a world where BTC and ETH can coexist, where you have BTC as kind of that like, monetary asset. But you also have, ETH as kind of this like underlying like, digital infrastructure for like the entire world and, the digital decentralized, financial plumbing, I guess you could say. So like, I think they'll coexist. To answer your question though, like over the long term, I think BTC, just because of the total addressable market of like the monetary premium of the world, is just larger than ETH. But in the short term, like I definitely think like in this next bull run, you could temporarily see ETH like flip BTC. I don't think that's like a controversial opinion. I think primarily like you'll really see the effects of kind of these supply dynamics that have obviously shifted since ETH transitioned to proof of stake that really haven't materialized to price action yet. I think the thing with ETH that you have to keep in mind is like as you build out like more verticals or like subsets of like network activity. Now we've got GameFi, NFTs, DeFi, borrowing, like etc. Like as that continues to GameFi, as it continues to grow out, right? You have more potential inflows of network activity to catalyze the supply dynamics, and I think the cynical take is that the network activity follows price, right? So like as crypto goes through like just this natural, bear market, and you come out of that and price bottoms out solely for the fact that like this is a speculative market, you'll see the network activity, in my opinion, follow the price. And once you kind of get that feedback loop between network activity, price, and on top of that, the narrative of, the supply dynamics and like the, eco-friendly aspect of ETH on a relative basis to BTC, like once you get, whether I agree with it or not, right? Like obviously like I'm more in like the Bitcoin ideological camp, but like I do acknowledge that like other people care about that, right? So like I think you have to be objective about it, and like I do think there's a very outsized likelihood that translates to some type of like reflexive feedback loop between all of those factors, and that could definitely like temporarily push ETH's price higher than you perhaps expected.
I see what you did there with reflexive there. But that's a perfect segue to where can people find you, Will? I'd love to hear you give a little shout out to your new research shop, and give yourself a little personal plug here.
Yeah, sure. No, appreciate you guys, and it's awesome you guys are doing the podcast. I ran a podcast for about a year. I know it's fun. It's a grind though for sure. So all the best to you guys. Hopefully I'll come back on soon and we'll get someone else from the team on. You can find me on Twitter at W Clemente III. You could find our research offering at reflexivityresearch.com. We cover everything from BTC, ETH, DeFi, and global macro. I covered the Bitcoin section, and then we have some other guys that are way smarter than me that cover the other sections. So if you're interested in that, you can.
That's awesome,
head over
and
there
thanks a lot
and
for
check
coming
out
on.
our
Well, this was a great discussion, kind of recapping, the state of the market for Bitcoin miners. Super informative. Really appreciate you coming on and dropping this knowledge for us. And best of luck to you. It's you're right. You're definitely right about the podcast being a grind. No kidding. But research in itself is no joke either. So best of luck and cheers. Thanks, man.
Thanks, guys.
Will.
Appreciate it.
All right, that was a great interview with Will Clemente. He's always super knowledgeable on everything Bitcoin. You guys should all go check out his research at reflexivityresearch.com. But Dan, how did you feel? What do you think about the struggling Bitcoin mining landscape? Is that bearish or bullish?
Yeah, it's super interesting. I think probably the biggest overall takeaway I had from our conversation was really that, if the public miner group as a whole were to sell all of the Bitcoin on its balance sheets in one fell swoop, it'd be 600 or so $1 million of Bitcoin. And looking at market structure, that it could probably get OTC'd over a couple of days and really not have like a massive impact to BTC price. I thought that was probably the biggest takeaway, just because my personal perception of going into this conversation was, we always hear about miner capitulation and the impact that could have on market structure. So I will say that that's bullish, but for the sake of argument, I'll try to kind of take the bearish side of all these things. And public miners do have 17% of the hash rate, and while that's not a controlling portion, it is still a significant amount of hash rate that needs to flow to a different portion of the network if they do go out. And if they start to consolidate, then now you go from 17% being spread out across 10 or 12 entities to 17% being consolidated amongst a handful. So it is interesting, but I do think it is something to watch for if some of these larger miners do go under.
Yeah, I'm just not too concerned about it. I mentioned in the interview briefly that there was 30% plus of the hash power went out when the China mining ban took place about a year ago. So I just don't really think hash rate's super important in terms of price structure. So I kind of agree with Will on that front. But I will say it's an important metric to look at over the long term in order to ensure that the health of the network is continuing to grow. What do you think about the companies being bought out, or maybe some mergers and acquisitions? Do you think that's bullish or bearish? Do you think it maybe centralizes the network? What are your thoughts on that?
Yeah, I think your last point's the takeaway from some of this M&A activity that could potentially go on. If some of the larger miners do go bankrupt and are unable to facilitate the debt that they've taken on, you're likely to see some consolidation here, in my opinion. There's still, the industry as a whole is still so young. There's going to be people willing to take bets on it. I know BlackRock's had their eye on miners for quite some time now. So it'll be interesting to see if they really make a push in getting more involved, if some of these larger names do go under. I think the centralization risk is probably the thing most important to keep an eye on, just given that, if one entity had 17% control, that would be a bit concerning. But if that's spread out around multiple entities, then it immediately becomes less of a risk, in my opinion. But definitely worth keeping an eye on some of these larger names.
Yeah, I would just go back to how cheap it is to run and operate a Bitcoin node. It's only $130. You can do it on a Raspberry Pi with an internet connection and minimal power sources. And at the end of the day, the nodes are kind of the end all be all of which chain we're following. So I'm really not too concerned about centralization as it relates to Bitcoin.
Right. Yeah. So if you think about kind of the fee-based model, to me, this is the biggest issue with Bitcoin. But how do you see a transition away from this security subsidy as a couple halvenings from now? It won't be as large, right? Today a block reward is 6.25 Bitcoin, but after in 2028 we'll go through two more halving cycles from now, and that 6.25 would fall to 1.56 Bitcoin. So if price were to stay the exact same, that's a change from $125,000 per block to around $31,000 per block. So how do you think the network can kind of adapt to this and make a transition?
Yeah, this has long been my biggest question in my head around Bitcoin, because I've long been a Bitcoin bull. I guess it comes down to two things. Can Lightning Network become successful? If so, then there's more transaction activity occurring at the end of the day on the Bitcoin base layer. So that's one route. And then two is you could potentially lower the block height, so that way less transactions fit in a block. And then basically you'd be intentionally congesting the network so that fees would make up a greater portion of miner revenue. But yeah, I would just tend to agree with Will. Like, I'd bet on human ingenuity. I don't think, Bitcoin bulls and devs are going to just watch this thing fold. I think that changes will be made as necessary. How about you?
Yeah, I think that's a great point. I do think Will hit the nail on the head with his comments around the Lightning Network, though, right? Like, if Bitcoin's this pristine asset and I don't want to spend it, I want to accumulate as much as I possibly can, and this is where I think stable coins have a huge role in the ecosystem, right? If I'm a Bitcoin maximalist, I love Bitcoin, then I want to spend as many dollars as I can and accumulate as much BTC as I can. And so stablecoins facilitate this perfectly. I like using a smart contract network, right? I can hoard and accumulate all these assets of my choosing while also having the ability to spend stablecoins. So I think, like, if you look at Ethereum, right, like I can hold wrap Bitcoin on Ethereum. Of course, that creates a new custody risk, but just putting that aside for now, if I'm accumulating Bitcoin on Ethereum and then spending my stablecoins, then I'm like able to accumulate while still spending. And so it's like, why? Like, I feel like there would need to be some sort of stable coin or some other currency that I'd want to spend on the Lightning Network before I could really see a true product market fit for that.
Yeah, and that kind of leads well into the last point I wanted to ask you about, Dan. And like, I was surprised with Will's reaction in, Bitcoin maybe not being as much of a reserve asset as it was initially meant to be. I asked it in the context of like other smart contract platforms, so like Cosmos, Terra tried it, and he maybe seemed bearish on that. But then he also said that 1, 3, 5% of a company's balance sheet should be Bitcoin potentially, but he doesn't see it ever being a fully reserve asset given the volatility in relation to the US dollar pair. So how do you feel about that? Do you think Bitcoin will ever be a reserve asset, or do you think there's just not enough utility around it to support that use case?
The volatility standpoint, like we're still, it's been over a decade since Bitcoin's inception, right? But it's still so young and it's a utility in the space that I do see the potential world where 20 years from now, Bitcoin's so established and there's just such a smaller amount of volatility around it. And that probably does have a lot to do with a shrinking block subsidy. Like, there's less sell pressure. One of the biggest distinctions I think you can like visualize is going to ultrasound money and playing with that proof of work, proof of stake toggle for how Ethereum would look if it was still on the proof of work network, or how it looks today, being that it transitioned to proof of stake and was able to kind of reimagine its tokenomics, and it's removed over maybe not over, but very close to $1 billion of sell pressure, right? Like, without these incentives flowing into the validators or the miners in the case of proof of work, the tokenomics do start to feel a little bit more sustainable. So yeah, I don't know. It's tough to say, but personally, I kind of like Sunny Agrawal, the Osmosis founder's take that Bitcoin's an app chain. It serves a very specific purpose, and where that app chain gets plugged in is like yet to be seen. But it makes a lot of sense. Like, I like the narrative of Bitcoin as this pristine collateral that's super simple and only serves like one function, and that is to have a structural monetary policy that does not change through time. I think that's a very attractive quality. It's just a question of like, where can I use that? And to me, it does look like on-chain resources make more sense. I think we need better ways to hold Bitcoin on different chains in a decentralized and secure manner. But yeah, as a whole, I do kind of like that thesis that it is hard money.
Yeah, I would agree. I really don't have much to add there. Like, I think Bitcoin is just so beautiful because of its simplicity and because of the fact that it moves so slowly and it's not trying to do so many things. It hasn't tried to do that experiment. ETH is kind of trying to be a monetary asset. It's trying to be used for payments. It's trying to be a smart contract platform. So I love ETH, but I do love Bitcoin and its simplicity, and I think there's a spot for that in the world. Like, no other chain is as easy to run a node on than Bitcoin, and I don't see that changing anywhere in the near future. So bullish Bitcoin.
Strong agree there. I think it's probably a good place to wrap it. So, appreciate everyone tuning in, and we'll see you next week on next week's episode of 0x Research.
Thanks, everyone.